Hey everyone, Richard Norris here, and in this video I'm going to share with you how to scale your property portfolio up using a refinancing strategy. This is a strategy that I've used to scale my property portfolio to multiple millions of pounds, and it's a strategy that I've been using it with my clients that's working really well. So I just wanted to share this video with you, and hopefully it helps you too. So if you don't know who I am, my name's Richard Norris. I've successfully grown a multi-million pound property portfolio. I've been investing in property for over 10 years now, and I've got over 300 clients that I've helped to grow their property portfolios too. So I just wanted to take some time to show you how this strategy works, and really in the hope that it will help you too. So let's say, for example, you're somebody who's a property investor already potentially, and maybe you've kind of been doing it over the years, but you haven't really scaled the property portfolio to where you want it to be. And maybe you've got a couple of properties in your own name, and you're not sure about how to scale that, how to refinance them in the best way. I want to share with you a strategy that I'm using with clients who are in this exact situation, how we've helped them to scale from 2 properties to say 10 properties within the last 12 months. And I'm going to share with you what the best way to do it is, because if you've got properties in your own name, not only am I going to show you how to scale and leverage and use a refinancing model to do that, I'm going to show you how to do it in the most tax efficient way as well. So let's jump into a quick calculation here that will really help explain what refinancing is and how it works when you're building out a multi-million pound property portfolio. So let's say that you've got a property at the moment and it's currently owned in your own name for this working example, okay? And let's say that the property is valued at £200,000, right? And you have a mortgage on it. Now, typically speaking, on a buy-to-let property, you typically can scale your mortgage on a loan to value of 75%. And that's usually the maximum loan to value that we recommend that you go up to scale your portfolio. And it's the same for a lot of property investors too. So, but let's say that this property, you bought it and over the years you've been repaying it down. So you've built up quite a large sum of equity in the property. So for this example, let's say that you've only got a mortgage on it of £50,000, okay? So in this example here, this would mean that you've got £150,000 of equity in the property, okay? And the way that the equity is worked out is you take your £200,000, the value of the property, you minus off what your outstanding mortgage balance is, and then that gives you your equity. So in this property, you've got £150,000 of equity. Now, what we can do to leverage our portfolio and scale up and go from, say, 1 property in this example to buying multiple properties in a short period of time is we can actually do something called refinance. And the way that refinancing works is like this. We basically say, okay, well, we've got £150,000 in equity in here. How do we get hold of some of this equity? How can we take some of this equity out and get it into our bank account, right? In order to grow the property portfolio and have that money left over to put down as deposits on other properties. So in this example, I'm going to raise the mortgage and I'm going to take out a mortgage of 75%. So what I do is I go to the mortgage lender and I say, look, I've got a property that's worth £200,000 and I've got a current mortgage on it of £50,000. I would like to raise a new mortgage against the property, please. And I would like to go up to 75% loan to value. Now, if we take £200,000 and we times it by 75% to get our new mortgage that we're able to borrow on this property, 75% of 200,000 is £150,000, okay? So effectively what we do is we take out a new mortgage for £150,000. Now, then what happens when you refinance is you basically take out the new mortgage and we pay back the existing mortgage, and the money left over, the difference, goes into our bank account as cash so that we can use that as future deposits to scale the property portfolio and expand. So in this example, we've got £150,000. This is the new mortgage against the original £200,000 property. Now what we do is we take the £150,000 and we pay back the existing mortgage of £50,000, okay? Now, in that example here, £150,000 minus £50,000, pay back the original mortgage, the outstanding balance of £50,000, we're left with a sum of £100,000. Now, that £100,000 is equity that we release, and we can typically use that equity to scale and buy more properties. Now, what we typically recommend, and what I recommend when I'm working with clients that's worked really well in this exact situation, is that we can take that £100,000 and we can actually put that into a newly formed property company, and we call a new formed property company an SPV, a special purchase vehicle. It's specifically set up for you to buy more properties, basically. Now, again, depending on your individual circumstances will depend whether you continue to buy properties in your own name or whether you continue to buy them in a limited company. However, typically what we typically do in this situation is we create a tax planning opportunity by putting the money into the limited company. And I'm going to explain to you why putting the money into a limited company and not buying the properties in your own name can create an excellent tax planning opportunity, and how we're doing this at the moment, how it's working. So we'd take the £100,000 and we'd put the £100,000 into our new SPV here. So this is our new limited company. Now in this SPV, what we can do is we can put the £100,000 into here, okay? And this £100,000 goes in as a director's loan account. So we take the £100,000 from here, we put the £100,000 down into here, okay, into the SPV, and that money goes in as a director's loan account. Now what that basically means is that this money that goes into the company is basically owed back to you. Now we can then use this money, we can take this £100,000 and we can start to buy some properties with it. So let's just say in this example that we put down £30,000 on 3 properties, right? To spend the £100,000, just as an example. So we bought 3 new properties with the £100,000 and put down 30k deposits in each one, right? Now, by releasing the equity, we create the opportunity to do this because we take the 100,000 and we can put that down as deposits across the 3 properties. Now, all of these properties will start to cash flow us money, right? They'll start to make us cash flow. They'll start to make us profit because we'll get the rent from them. Now, let's say that all 3 of these properties, keeping things high level for now for the purpose of this video, that they all make roughly £300 of profit, okay? So they each make £300 of profit. Now, that's effectively £900 a month. So I should have said, sorry, up here that this is per month, £300 per month. Times that by 3, we get £900 a month is what those properties make us. Now, basically, if we take the £900 and we times that by 12, we basically get a net cash flow of, let me just double check this, 10,800 a year, right? I'm just going to double check that on my calculator here, but I'm pretty sure that's what it is. 900 times 12 equals 10,800. So we create £10,800 in net cash flow. Now, this money here, this £10,000 can be paid back to you alongside any other income that you have in your life. Without paying any tax. So the reason that this can be paid back to you from the limited company, you can draw that as income into your personal name without paying any tax, is because the money, this 10,800, comes out against your director's loan account. And remember up here, we created a tax planning opportunity by releasing the £100,000 from the property in your own name and then putting it into the limited company's director's loan account. Because it's gone in as a director's loan account, the company owes us £100,000 back before we start to declare taxes on the income. So in this scenario, we can use this £100,000 and it can be put into 3 properties. Now, don't forget, guys, that all of these 3 properties are also going up in value as well. So you've now got 3 properties going up in value, and you've got 3 properties that are paying you £300 a month, which is £300 each a month, which is not a total of £900 a month. That £900 a month makes you £10,800 a year. The £10,800 a year comes out tax free because effectively, if the company owes us £100,000 back as a director's loan, we could draw out £10,000 a year, and we could do that for 10 years, and then we've paid ourselves back the £100,000, right? But after we've paid ourselves back that £100,000, then we have to declare income, and we declare the income via dividends in the company, and they'd be taxed at 7.5% up until £50,000. And you may choose to do your personal allowance as well. But I don't want to get into the granular details around taxes in this video. I just want to show you basically how to scale off a property, release the equity, put it into the limited company so that it creates a tax planning opportunity so that you can really start to leverage and scale the portfolio in the most tax efficient way. And this is exactly the strategy that we're using within our business with our current clients who are in this exact position, where they've got a property or a few properties in their own name and they're looking to expand and scale in the most tax efficient way. So that's really how to do it. But now, like, the reason why also I just wanted to like reiterate this point, why the money comes out tax-free, is because also the money up here, this money that goes in, this £100,000 that goes into the company, goes in as tax-free money as well. Because when you release equity from a property, the equity that you're releasing, you're basically releasing new debt. So you're taking out good debt to scale the property portfolio. And because you're taking that out as a loan to us, basically as a loan to put it into the company and a director's loan, that money comes out tax-free, because any debt that you pull out of your properties is not taxable. HMRC do not see it as taxable income because it's debt that you're drawing down to scale. And that is why you don't pay any taxes when you do an equity release. And because the money goes into the director's loan account and there's no taxes to pay, that director's loan account is due back to you before you start declaring profits. So we invest 100K, we can buy multiple properties by doing so. We can create tax-free income on the back of it up until a certain level, basically up until the director's loan account has been utilized. So if that figure was say 200,000 and we paid ourselves 10,000 a year as an example as income from the portfolio alongside any other earnings, then it would take us 20 years to pay back the director's loan accounts. We'd have 20 years of tax-free money if we just withdrew 10,000. But the likelihood is that you're going to be withdrawing much more income from the portfolio above 10,000. And therefore, in that scenario, you just basically divide your income, so the income, and you take that income and you divide that by the money that you put in, the director's loan account, and then that will tell you how many years that you have to draw down tax-free. So that's basically the strategy that we use to scale our portfolios. It's the strategy that we use with clients who've got properties in their own name. And you can also apply this to, like, if you've got properties in your own business and you're scaling up or you're starting out, you can refinance your assets within your business as well. It all comes out tax-free. The only thing is, in the business, when you draw it down, you can't draw it down as a director's loan account, and therefore it's taxable if you're basically scaling by refinancing properties in the business. But if you're scaling off of a property that you've got in your own name, or properties that you've got in your own name, you're taking out and you're doing an equity release and putting the money into a limited company here like this, an SPV, as a director's loan account, then you can buy new properties and draw the income out tax-free. So I hope you liked this video. If you did, please hit the like button. It will really help me. It helps people, more people see our videos, and it helps the algorithm so that we get more people watching our videos as well. So that would be really helpful to me if you could hit the like button. I'd really appreciate it. And like, if you haven't subscribed to my channel already, hit the subscribe button, and also click the notifications, click the bell, that's the notifications, because I deliver new content on a weekly basis. We upload multiple videos a week. You'll be notified when they get uploaded, so you can watch other videos like this that may be helpful to you. And also, if you just leave any comments or questions in the feed below, I can go in and answer those questions, or somebody from my team can go in and answer those questions for you. If you've got any questions surrounding this video and any questions surround refinancing properties in your own name, we'd love to help. So yeah, I hope you enjoyed this video. Thank you for watching. Be resilient, be great. I believe in you, and I'll see you in the next video. Speak soon.